Hello, this is Michael Swanson. I run the website WallStreetWindow.com, and I want to talk about what's going on in the markets because there's something very interesting on the technical analysis charts. The Bollinger Band indicator on the SP 500 is doing something that actually doesn't happen very often and suggests that tomorrow or next week another big move is going to start in the markets. First of all, let me show you what's happening on the short-term 60-minute chart. Okay, this is a 60-minute chart of the SP 500. It actually, you can see from this that it hasn't really gone anywhere since, let's say, the 27th of April. Really, the 20th of April, it hit 2880. And right now it's at 28.94. Not that much difference. When you look at a chart, you get a better feel for what's happening than when you simply look at the daily action on an app or on the television or on a website. Because we see today, the S&P's up 45 at the moment, the Dow up over 300. That feels like a giant, massive gain. But when you look at the chart, it's just where it was a few weeks ago. Nothing is really happening. But take a look at this. I want to explain what's happening with the Bollinger Bands. So here's the SP 500. And the peak lines on this chart are 20-day Bollinger Bands. Now the indicator at the bottom of the chart measures the width between those two bands. Price trades between the two bands, but what the two bands are measuring, and this is what's important about them, is the volatility, the true price volatility. The bands expand when volatility increases. That means the daily price moves are large, and when we saw the stock market collapse in March, the S&P 500 fell over 30%. Those Bollinger Bands became very wide between each other, and the width indicator, as you can see, went above 40. Something it hadn't done in in a very, very long time. Actually, I've been doing this since the 90s. I don't know if it's even gotten above 40 in all the time I've been doing it. But anyway, it was a rare occurrence. What's interesting or important about the bands is when the width gets extremely large, typically the bands will then narrow. And then when the bands narrow, it means that the volatility is shrinking. And at some point, the bands contract and start to expand to signal new volatility coming in. And that's what the bands are now setting up. So the S&P 500 and the Dow really haven't gone anywhere for 2 or 3 weeks. The bands have contracted as a result of that. And this indicator suggests that that's going to start to change, if not tomorrow, then next week, to set up the start of some bigger moves in the market. It'll break out of the range. Basically, it's been locked in. The S&P 500 has had support now at 2,800 for 2 weeks. Resistance about 2950 or so. And it's going to break to the upside or the downside. The bands don't tell us what direction the break is going to happen, but it's going to come. And if it's to the downside, that would suggest that the rally is broken. Doesn't mean the market's going to crash, but the upward momentum from March is over with. If we break to the upside, then we'll be looking for a test of the next resistance level at 3,000, which is the upper 200-day Bollinger Band. And what you've got to realize is that there's 3 trends in the market. The short-term trend, and I'm not talking about what you see on the daily move on your app or on the television set, but what you can see on that 60-minute chart, the intermediate term trend, which is visible to us on this daily chart, in which is what the 20-day Bollinger Bands signal us, changes in that usually last a week when the Bollinger Bands trigger. But then there's a long-term trend. And successful trading basically means aligning yourself with all three of those trends, using short-term oversold signals to get into intermediate-term uptrending markets that are part of long-term trends. So this is where the difficulty actually comes with these markets. First of all, let me stop for a second and tell you the Bollinger Bands are a very useful indicator, and I use them in this way to measure the volatility. If you want to find out more about them, just go to Wikipedia and type in Bollinger Bands. You can find detailed on how they're calculated, and there's other ways people use them. Some people use them to do short-term trading, buy when something hits the lower band, sell when it hits the higher band. I don't do that kind of stuff. I use them to signal when something interesting is about to happen in the market, because frankly, nothing has really been happening for almost 2 weeks. But I think that's about to change. The bands are telling us that's about to change, and now it's time to start to pay attention. So, most people, though, in the stock market right now are extremely bullish. They see the drop in March as a buying opportunity to load up. They believe that the economy is going to recover from the shutdowns and boom in the second half of the year, so they're buying stocks. And one indication of this is on Google Trends. You can find out how much interest there is in a search term, the number of times people are typing something in Google compared to past history. Well, the number of times people are typing how to buy stocks has surged to a record. There's approximately 4 times people doing it in the past few weeks than there ever has been before. The same thing happens when you type in bull market. And people are buying into the rally. And also there's a surge of new traders coming into the market for the very first time. I've talked about this in the past few videos I've done, and it's been covered in financial articles in the financial media, but it's hitting the mainstream news websites now. So here's a story yesterday about the coronavirus-driven gold rush, where people are getting on their finance apps to buy stocks. Finance apps have seen a 55% growth in usage time from the end of 2019 to April. Ameritrade reported 608,000 new funded accounts in the first quarter, 3 times that was seen last year at the same time. E-Trade, Schwab, Fidelity reporting the same thing. These are mostly new people. Ameritrade knows that because it tracks the online activity of these people. Many of them are going to look for lessons about how to enter trading orders, stuff that's really basic starter information. And the thing is that millennials are trying to jump into the market. They believe that corrections and crashes are buying opportunities. This is what they've seen in their lifetime since 2008, and so they are trying to do that themselves. However, it's not as easy as they think it is. It takes experience. It takes willing to do the work to really educate yourself. And also, the most important thing, it takes aligning yourself with the key trends. If you want to beat the market, you've got to be in the sectors and the stocks that aren't just beating the market the morning you open up an app, but are doing so on long-term charts, intermediate-term charts, and then using short-term action to get entry points. So I use something called stage analysis to analyze this. Basically, the long-term trend can be easily identified by whether something is trading above or below the 200-day moving average. If it's below the 200-day moving average, typically what happens is you get rallies back up to that, and then the rallies stall out, and you can get drifting action for weeks, sometimes months, and then a resumption of the overall trend, which is a bear trend. If we look at the SP 500, what we're seeing is a rally back up towards the 200-day moving averages. And that's a counter trend rally in what has begun a bear market. Because look, I know all the talk of a big boom If you look at what analyst calls are saying of companies, companies aren't seeing that. They're not looking at a big boom in the second half of the year. Look at what's going on with the airline industry. Look at what's going on with casinos. Look at masses of companies that are suspending their dividends, suspending their buybacks in order to shore up their balance sheets so they're going to be able to ride out the next year. General Motors just announced no dividend. Ford announced no dividend last month. This is going on across the board because companies know things are not going to start to boom. Even though it's good, the economy, parts of the economy are opening back up, it's not going to be what it was like in February. And yes, we've had a fun rally in the market. I have thought of it as a return to normal, open back up market. And now that parts of the country are starting to open back up, that trade is nearing an end. And if you want to make more gains in the market, sustainable gains in the market, I believe the thing to do is look for stocks that aren't simply rallying back up to their 200-day moving averages, but are above them, that are beating the stock market averages, that are crushing it. Newmont Mining is one such stock. I own Newmont Mining for that reason. But the price of gold itself is doing the same thing. If you look at the GLD ETF, gold is above the 200-day moving average, the 150-day moving average, and the 50-day moving average. Gold is beating the stock market. Gold is beating almost every sector of the market. When it comes to the market itself, the outside gold, outside biotech, and a few other sectors, it's really a half dozen big cap tech stocks driving the market gains. Most things in the market are not doing very well. For example, bank stocks are lagging the market. This is the XLF ETF. Hasn't been able to even get close to the 150-day or 200-day moving averages. But there's many other things. Jets, the airline ETF, has crashed and is trading on its recent low despite having bounced last week. And that's the difficulty. When you see something that has fallen a whole lot and you see a big up day, is it simply a bounce or is it something that is part of a rally that's going to continue? You don't want to just buy something that's going to bounce for 3 or 4 days and fizzle out. And that means looking at charts like this. You really can't get enough information from looking at what something does that given day. You've got to look at the chart. The chart puts it into context with what has come before. It's critical information. That's why we always use charts as part of our analysis when it comes to entering stocks, exiting stocks, what sectors are good, and then you think about the fundamentals to back it up. Newmont Mining is one of the biggest mining companies in the world. In fact, Newmont Mining reported earnings this week. They did not cut their dividend. Instead, they boosted their dividend. They increased their dividend. Think about that. While most companies are suspending dividends, Newmont is increasing. This is not to tell you to buy Newmont. This is to tell you that the mining world is a place of true fundamental strength being aided by rising gold prices. It's a pocket in the markets, which makes for incredible trading opportunities, incredible investment opportunities, and so forth. When it comes to the SP 500, I'm not sure what this is going to do. It's tough to make money in things below the 150-day and 200-day moving average. What's interesting about today's action, though, is that the 20-day Bollinger Bands are tightening, and that suggests that this kind of lull that the market has been in for roughly 2 weeks is soon going to come to an end. Are we going to get another thrust up? If not, then we're going to start to see a thrust down next week, which will be interesting to see. That doesn't mean I think the market's going to go straight down to the lows or something, but it'll be a situation we will have to now keep our eye on to see how things unfold. If the market does make a drop and resolves this pattern to the downside, the sectors lagging the market will make another leg lower. That's what will get beaten up. Things like airline stocks will get beaten up. Things like regional banks will likely to get beaten up. And there's all kinds of things trading weak. That doesn't mean biotech's going to crash. It doesn't mean mining stocks are going to drop either. In fact, gold is benefiting from the macro picture when you see the Federal Reserve printing unlimited money, when you see the U.S. government doing bailout after bailout bill. That is driving people into gold, and it's something that's going to continue going forward because that's the macro environment that is defining the action in precious metals. So these are my thoughts for today. Interesting development. It's going to be interesting to see what happens with the S&P 500 and that 20-day Bollinger Band. Now, let me tell you real quick, when it comes to technical indicators, I often get asked, what are my favorite indicators? Well, the Bollinger Bands are one of them. But one trap that people do end up in when they start to use charts or get into indicators is trying to use too many at once. If you would have noticed my charts, I only have a few, the moving averages, the Bollinger Bands, and there's stochastics at the top. That there's something that I should talk about in another video. But I only use a handful of indicators. If someone is putting 10 or 20 indicators on a chart, they're overloading themselves with too much information. It's best just to use a few and get knowledge about them, get a feel for them, and then go from there. The indicators are really designed not to predict the future, but to tell you what is happening on the price charts to help you interpret them better. And the Bollinger Bands are simply telling us that the market has paused for roughly 2 weeks. That pause is likely to end and result in a sharp move one direction or the other. We'll be watching to see which turn it takes. But look, buy gold stocks. That's a lot easier than trying to trade the S&P 500 or go against the trend in crashing stocks. Uptrends are so much easier. You just buy a small position, you hold, and you ride it. It's simple as that. So anyway, if you aren't on the email list, again, click the link associated with this video and get right on it.